Okay, so let's go ahead and build a mini LBO model in this video. You can download the attached spreadsheet. It has two tabs. It has the mini LBO blank tab. It's the one you have in front of you, and it has the completed version of the model also. We're gonna be using the mini LBO blank version. We're gonna complete this tab here to build the model together in this video, and you can use the completed version either during this video or at your free time to check your work. As you can see, it's a very simple and small model. It's just 100 rows, approximately 100 rows. So let's begin. So we're going to start with a mini LBO blank tab, as we discussed, and let me walk you through the various sections of this model before we start completing it together. So I'm going to skip a few sections and jump to the income statement section over here. So as you can see, this is the income statement of a fictional company. Doesn't really matter at this point in time. It's a company that has revenue of 1,000. Doesn't matter what this represents. EBITDA 300, operating profit of 100, and eventually after you deduct taxes, you get to net income of 79. So this is the historical income statement of this fictional company for 2019 actual, and we're going to use this income statement together with all the other assumptions that we're going to make in order to project the various financial statements for the next 5 years, from 2020 to 2024. 5 years is going to be our projection period. The assumption is that we're going to be buying this company in 2019, and we're going to operate this company for the next 5 years and sell it in the end of the 5th year. And we're going to see how the numbers are going to work out. Now, starting from the top, we have the sources and uses section together with evaluation. Over here, we have certain assumptions that we're going to be making. It's very simplistic assumptions: revenue growth per year at 5%, net working capital, we're going to look at it as a percentage of revenue, same for capex, then cash balance at acquisition is going to be 0. We're going to assume that we're buying this company on a cash-free, debt-free basis. The income statement, we went through it before. We're going to conduct a very basic margin analysis here for 2019, and we're going to use the same relationship going forward from 2020 to 2024, our projection period, in order to project the various line items in the financial statements. We have the cash flow section. The actual cash flow statement for 2019 doesn't really matter. We're just gonna build the cash flow statement from 2020 to 2024, just for a projection period. We have our cash and debt schedule section. We're going to assume that the LIBOR stays constant at 1%. This is, again, a very simplistic assumption. And over here, we're going to build our cash schedule. We're going to work on our debt roll forwards, the revolving credit facility, term loan that we're going to assume, senior note that we're going to use to finance the acquisition of this company. I'm going to calculate the total interest, and finally we are going to go over the return analysis, which will give us an IRR and a multiple of invested capital, depending what year we decide to exit. So now that we've gone over the various sections, let's start building the model, and let's start with the valuation section. So as we said, the last 12 months EBITDA is 300, right? This pulls from the income statement that we went over previously. It's the 2019 actual EBITDA, and this is the figure or the metric that we're going to use to come up with a valuation for this company. We're going to apply an enterprise value to last 12 months EBITDA of 5 times. Actually, let me delete this completely and build it together. So last 12 months EBITDA, we're going to pull it from the income statement. So this is the last 12 months EBITDA. We're going to assume a multiple of 5 times. So this is going to be the enterprise value, 1,500. And then to get to the equity value, we need to deduct debt and add cash. Again, as we mentioned previously, we assume that we are buying this company on a cash-free, debt-free basis. So both of these numbers, let's say, are 0 for now, hence the equity value is the sum of these 3 line items, which is equal to the enterprise value since there is no debt and cash in this specific instance. So let's go and build whatever we can build from the, actually we're going to build everything right now from the sources and uses. So let's see what the uses are going to be first. So the uses, we're going to use cash in order to buy the equity of this company. So not cash necessarily, we're going to use funds to buy the equity of this company. The equity of this company, we just calculated it, it's 1,500. Now, we're going to assume that there are certain financing fees and transaction fees. We'll get to those once we have completed the sources section. So let's say that the sum of these 3 line items, and then let's say that the sources that we're going to use in order to acquire this company are going to be as follows. We're going to see them as a multiple of EBITDA. So we're going to get our revolving credit facility, which is going to be 1 times our EBITDA. I'm going to lock this by pressing F4. Sorry, it's 1 times EBITDA, so I'm going to multiply this by the EBITDA over here, last 12 months, EBITDA for 2019, and I'm going to lock this cell because we're going to use it for the other facilities as well. So this implies a 300 million revolving credit facility, 300 million, whatever this number is, doesn't really matter. Term loan, 2 times EBITDA, this is 600, and then a senior note, 1 times EBITDA. Again, these are just assumptions. It's a fictional company. So 1 times EBITDA, 300. And then let's go back to the uses now. So transaction fees, let's assume that the transaction fees are going to be 0.02% of the equity value. And then let's assume this, let's mark this in blue because this is a hard input. And then the financing fees are going to be 0.01%, 0.01 or 1% times the sum of the 3 facilities. Again, very simplistic assumptions. Let's mark this in blue since it's a hard-coded number. So these are our total uses, and the question is, how are these going to be financed? They're going to be financed with 300 million from a revolving credit facility, 600 million or whatever the number is from a term loan, senior note 300. The sources always need to match the uses. And then the difference between the total sources and the debt that we're going to raise is the equity, which is 1.1 times the EBITDA. So these sum up to 1542 over here, which is equal to 1542. So we know that we've done it correctly since total uses and total sources are equal. Let's move now to the other assumptions section and see what assumption we're going to make here. So we're going to assume that revenue is going to grow on a yearly basis by 5%. Net working capital is going to be 1% of revenue. CapEx is going to be 10% of revenue. And cash balance, as we mentioned, is going to be 0. So Let's move to the income statement, which we've gone over previously, and the margin analysis. So the margin analysis is, we see what the EBITDA margin is for the historical financial statement, for the historical income statement. It's, let me start building this from the beginning. So EBITDA margin is going to be 300 over 1000. Depreciation amortization, it's an expense. I'm going to start with a minus sign. Depreciation over amortization over revenue, there's going to be 20%. And then we're going to have a implied tax rate of 21%. Now we're going to assume, as we mentioned previously, that these relationships are going to, or these ratios are going to remain the same going forward, constant. And we're going to use them to back into the projected income statement line items. So there's going to be 30 going forward, there's going to be 20, and the tax rate is going to be 21%. Select these, select the projection period, Control R to copy the formula, the figures to the right. So these are our assumptions going forward for this specific line item. So let's see now how we're going to build our projected income statement line items. So revenue is going to be, it's going to grow, as we said previously, at 5% per year. So there's going to be 1000 times 1 plus the 5%. I'm going to lock this, pressing F4 and copy this to the right, Control R. EBITDA is going to be 30% of the projected revenue. Is going to give us an EBITDA that is growing, of course. It's 315 for 2020 and grows to 383 in 2024, where we're going to exit. This is an important line item because we're going to use it to value our company at exit. Now, depreciation, very simple. This is an expense, so it's minus. So it's depreciation, amortization, 20% times revenue. Copy this to the right. Let's get the sum of EBITDA and depreciation to get our EBIT, our operating profit. Interest expense, we're going to come back to interest expense afterwards once we complete our cash and debt schedule. So for now, let's mark it with yellow in order to make sure that we remember to come back and complete this line item. The capital structure of this company doesn't really matter. The existing capital structure in 2019 doesn't really matter. Hence, the interest expense doesn't matter. That's why we haven't included any figure here. The capital structure is going to change completely because we are raising these three facilities, debt facilities, and we supplement this with this equity amount in order to buy this company. So whatever the previous capital structure of the company was, doesn't really matter because now the company with this LBO is going to be recapitalized. So let's go back to the income statement and continue with this exercise. So earnings before tax is going to be the sum of EBIT and interest expense, which we're going to calculate, as we said, later on. The taxes, it's an expense, so minus times our tax rate. And finally, your income, or your net income, which is the sum of EBIT and taxes. So we're done for now with the income statement. We just need to come back later on and complete the interest expense section. So margin analysis, we're done with that too. Let's go and build our cash flow statement. What I'm going to do over here is I'm going to split the screen. I'll do it by pressing Alt-WS. This is going to split the screen in two, and it's going to make it easier for us to bring the numbers from the top screen to the bottom screen. I'm going to navigate between the top and the bottom screen using F6 and Control F6. So I'm going to bring in net income from above in order to build our income statement, start building our income statement. So it's equal F6 to move to the upper screen, net income. net income. We will add back depreciation and amortization, so there's going to be negative since it's a non-cash expense. Add back depreciation and amortization. We're going to deduct change in net working capital. So if you remember change in net working capital, we're going to assume it at F6 to move to the above screen at 1%. So we're going to lock this F4 times the revenue. This is the assumption that we're going to make. So the revenue is over here in the income statement. So we're deducting that, and this takes us to a very simplistic cash flow from operations. It's the sum of net income, add back of D&A, and deduction of change in net working capital. Now let's move to CapEx. We're going to deduct CapEx. Again, as you remember, we have the assumption over here in the other assumption section. So let's get it from here. So CapEx is going to be 10% of revenue. Let's lock this since it's going to be the same for every year during our projection period. F4 times our revenue, F6 again to move to the upper screen, and we get revenue. This is negative. And then mandatory amortization, this is in relation to the term loan that we're gonna raise in order to partly finance this acquisition. So we're gonna complete this later on once we have built the cash and debt schedule. So let's mark this in yellow for now. And this is gonna get us to a pre-revolver cash flow or free cash flow, which is the sum of CFO plus these two items. We're gonna get our revolver once we're gonna get we're gonna complete this line item, the revolver, once we build our revolver in the next section. Post-revolver cash flow is gonna be the sum of the pre-revolver cash flow and the revolver. Discretionary payments, whatever this number is gonna be, and then we're gonna get to our free cash flow to equity. So let's get these formulas over here and copy them to the right, Control R. So now we have an almost completed cash flow statement. We just need to get two very important line items, the mandatory amortization, which is in relation to the term loan, and the revolver, of course, which we're gonna start working in just a bit. Now let's return back to the one normal screen. So here we have the cash and debt schedule. So as we said, the cash balance, the initial cash balance of this company is going to be 0 because we are acquiring the company on a cash-free, debt-free basis. So this number is 0. Here we're going to build the cash roll forward, right? Which is pretty much as follows. The ending balance of the previous period is equal to the beginning balance of the current period, right? So the previous ending period balance was 0 for cash, which is equal to the beginning period balance for 2020. We copy this formula to the right, and we calculate the sum of the beginning period balance plus an increase or decrease that we're going to get later on to get us to the ending period balance for 2020 and the remaining periods. So again, this is very simple roll forward for those who haven't seen it before. Beginning period balance equal to the ending balance of the previous period. You copy this formula across, and then you get the sum of the first two line items, beginning period balance and increase, decrease in cash, in order to get the ending period balance. Now, we're gonna complete this section later on, so let's mark this section in yellow. And let's start with our debt schedule for now. So I'm going to split this screen again. Alt WS. So revolving credit facility. The amount that we raise is equal to, we press F6 to jump to the screen above. We go to sources. It's 300. Again, we build the roll forward as we did with cash. This is equal to the previous balance, previous ending balance. We copy the formula to the right, and then the ending balance is equal to the beginning balance plus an increase, decrease in the revolver. This is the shell for the revolver. Let's do the same for the term loan. The term loan, the starting balance is going to be equal to 600. We get this from our sources. We build the roll forward again, copy to the right, get the sum. And finally, we move to the senior note, which we're going to do the same thing. We pull the number from sources. It's the senior note over here, 300. And we build the roll forward. And we copy the formulas to the right. All right, now let's go over our schedule to see what we are missing. So let's calculate this section and the revolver, which is one of the most important sections of this LBO model, and it's the one which might be it's the one that might be not that much intuitive. So let's see how we're going to do this. So beginning period cash is equal to our beginning period cash, which we have it from here. So this is straightforward. Now we're going to add to our beginning period cash balance the pre-revolver cash flows that we've calculated from above. So this is going to be equal to all the cash flows that have been generated. You get this from the income statement, from the cash flow statement, just before you start servicing the revolver over here. So this is 177. Copy the formula across and take the sum of these two numbers. So this pretty much is going to give us what cash flow during every projection period, what cash flow is going to be available for or available to pay down, or how much cash flow is going to be needed from the revolver. So in this specific instance, as it is the model right now, you have a cash balance that is 0. You generate 177 from these line items, 177. So the sum of these two is 177. So this is the amount, the funds that are going to be available for the revolver. So 177 are going to be available to pay down the revolver right now. And the same goes for the remaining years, the same line of thinking. So now that we've done that, let's link these figures over here to the revolver. So since this is positive, it means that this is cash available to pay down the revolver. So this is going to be equal to minus this. This is, again, this is positive, so there is available cash flow, and this cash flow is going to be used to pay down the revolver. So this is why this should be negative. And then the other thing that we need to adjust for here is we need to make sure that this automated mechanism is not going to over repay the revolver, right? We don't want to be in a situation where we produce too much free cash flow pre-revolver, and this cash flow starts paying down the revolver and never stops doing that, even if the balance of the revolver becomes negative. So just to illustrate that, if for example you had a free cash flow generation here of pre-revolver of 500, let's say, this would result to a negative balance in the revolver if we just use this formula over here. This is something that's not right, so we need to make a minor adjustment. So we're going to say that this is equal to minus the minimum of this figure over here and the initial balance of the revolver for each specific period. So this is the minor adjustment that we do. So here what it does is it uses the entire amount, 177, to pay down the revolver, gets it to 123 from 300. And then the next year, although you produce 186, this formula doesn't use checks and doesn't use the entire amount. It just uses 123, since this is the minimum between 123, which is the beginning balance over here, and the cash flow that was generated pre-revolver. And it pulls the minimum 123 in order to end up with a minimum revolver balance of 0. So we copy this formula to the right, and we have the revolver over here that is pretty much completed. So what we have to do now is go back to our cash flow statement and bring the number, the amount from the revolver. We're going to pull it from the roll forward schedule we just built, which is over here, 177. So this says that, all right, pre-revolver we had 177 free cash flow. And then since this is available cash, we use it, 177, to pay down the revolver. The next period, we're going to use 123, and it's going to give us, and we're going to end up with a post-revolver free cash flow 64. This is the sum of these two numbers, and the same logic goes until the end of the projection period. So what we see here at this point in time with the work that we've done is that the revolver is being paid down the first 2 years. After that, revolver is at 0, so no cash is used to either pay down the revolver or draw money from the revolver. Okay, so now that we're done, almost done with the revolver, let's go and calculate interest expense for our facilities. So interest expense for the revolver facility is going to be equal to the spread plus the LIBOR. I'm going to lock this cell by pressing F4 twice because we're going to use it in the other loan facilities, times the average balance of the revolver. So this is interest expense for the revolver. For the term loan, it's going to be relatively similar. It's going to be equal to the spread times the LIBOR times average balance of the term loan. Slightly higher interest expense since you have a much higher loan balance. So this is 30. Also, let's assume that the term loan is amortized. There's a mandatory amortization for the term loan, which is 10% every year, right? So the starting balance is this, F4 to lock it, times the 10%, and this needs to be negative since it's a debt repayment. So this is copy formula to the right. So this is the mandatory amortization for the revolver. As you all already thinking, we're going to have to link this to our cash flow statement. We're going to do this in just a bit. And then just to finish here, we're gonna work on our senior note. So senior note, you just have a coupon over here. Let me delete this interest in order to calculate it together. So you just have a coupon. LIBOR doesn't really matter, so it's 8% times the beginning period balance. Doesn't really matter here because there are no repayments in the senior note. You just have a bullet repayment in the end of this note. Let's assume that this note is for 5 years, so it gets paid down in the end of the 5th year. So the interest is going to be 24, and then you end up with a total interest number here. Now let's build it together. This is interest from the senior note plus interest from the term loan plus the interest from the revolving credit facility. Let me just rename this. This is revolving credit facility. Let's change this over here to revolving credit facility. All right, so here we are, interest. So this is the sum again of senior note interest, the interest associated with the term loan and with the revolving credit facility. Copy the formula to the right. So we have the interest expense now. Let's split the screen again and link the interest expense to the income statement. As you remember, this was the first line item that we left unfinished. So this is going to be equal to interest expense on the income statement is going to be equal to minus Control F6 to jump to the other screen. Sorry, minus the interest expense that we calculated here. 24 all the way. 24. This is the interest expense. Let me just double check here because I would expect the interest expense to actually go down since we're paying down the facility. Let me okay, yeah, I am sorry about that. I linked didn't link the total interest. I just linked the interest for the senior note. So let's go back over here to the income statement. So this is going to be equal to the total interest over here. All right, that looks more correct. Okay, and let's see now what else we have to complete. So we're done with all these sections. We've completed our income statement. Cash flow statement, we just need to bring in the mandatory amortization figure from the term loan roll forward. So this is going to be equal to the mandatory amortization over here, 60 per year. So let's unmark this, no fill. Let's unmark this again, no fill, since we're done. We are done with our cash flow statement also. So we see that pre-roller, we have a lot of cash flow that we generate. We use some of this cash flow in the beginning to pay down our revolver, and we use cash flow to pay down our revolver during the first 4 years, and then the last year has been paid entirely, so no funds are used to pay down the revolver. And then discretionary payments, let's assume that discretionary payments, debt payments, are going to be blank for now. So we have a free cash flow for the period 0, 0, 0, and then you start building cash 49 2023 and 124 in 2024. The final step is we need to link this free cash flow line item to the cash roll forward, because as you remember, we are starting with a zero cash balance. So beginning period in 2020 is going to be 0, but we're going to be generating 0 over here. Second period, again, we're going to be generating 0 because we're using all the cash to pay down the revolver. Same for the third year. And then the fourth and fifth year, we're going to be generating in total 173. We've completed this section 2. So let's just move to our return analysis section. So again, let me just split the screen once more. So we're going to calculate our returns for every year during the projection period from year 1 to year 5. Now, the EBITDA in these respective years is going to be as follows. We're going to pull it from the section over here, the income statement, which we forecasted together. So we're going to pull it from here, copy to the right. We're going to assume an exit multiple that is going to be the same with the multiple we paid at acquisition. So this was 5 times over here, you remember in the valuation section. So we're going to assume that we're going to be exiting at the same enterprise value to EBITDA multiple. So it's going to be 5 times. So the enterprise value at exit is going to be the EBITDA, the last 12 months EBITDA at exit, times the multiple. It's going to give you this enterprise value depending on the year that you decide to exit. And then to get to equity value, we need to deduct net debt, or deduct debt and add back cash. So debt is going to be the debt balance of the sum of the debt balance of the 3 loan facilities. So the revolver is here. We are going to add the ending debt balance of the term loan facility, and we're going to also add the ending loan balance of the senior note, which doesn't amortize because it's a bond, hence it's going to be 300 during the entire period. So this is our debt, and then we also need to add back cash. So cash, again, F6 to jump to the screen above, we're going to get it from the cash and debt section. Specifically, we're going to get it from the cash roll forward. So this is the ending cash balance. We're going to copy the formula to the right and take the sum of these numbers, the enterprise value at exit, debt, we deduct pretty much the debt, and we add the cash in order to get to the equity value at exit. And then we want to look at the initial equity that we contributed in order to buy this company. As you remember, this can be found in the sources and uses section. So in the sources section, we use the revolving credit facility to finance the acquisition of the company, the term loan, the senior note, and the difference was the equity. So this is the amount. Let's lock this F4. So this is the initial equity that we paid. We copy this to the right. And finally, let's calculate the 2 return figures, right? The one takes into account the time value of money, the IRR, and MOIC does not. So MOIC is going to be equal to the equity value at exit over the initial equity value, or over the initial equity that was paid, right? So this is 1.5 times. We copy this across. And then we have the IRR over here, which is equal to parentheses exit over the initial equity, and we raise this to the power of 1 over the exit year minus 1. So we get to an IRR in the end of if we exit in the end of the fifth year, 2024, of approximately 35%, which is a multiple of invested capital of 4.3 times. Let's just compare this with our finalized model to make sure that we have the same numbers. So 34.2, 4.3 times. So we are correct.